$240,000 could vanish from your heir's inheritance in just 16 months, unless you act before Congress resets the estate tax exemption on December 31, 2025. If you earn $200K plus, own a business, have investment accounts, or carry real estate, this deadline applies to you. The current federal estate tax exemption is $13.61 per person in 2024. Starting January 1, 2026, it drops to approximately $7, a 48% cut in one day, unless Congress extends it. Most people think the exemption is permanent. It's not, and that assumption could cost your family $500,000. Here's the math that matters. A married couple with a $15 combined estate pays zero federal estate tax today. In 2026, without planning, that same couple faces a $3.2 federal tax bill, 40% on the $8 that exceeds the new exemption. Add state-to-state taxes in Connecticut, 12%, Maryland, 16%, or New York, up to 16%. And you're looking at $4 to $5 erased from what your children actually receive. That's before probate fees, attorney costs, and the time your heirs spend in court, instead of running the business you built. But here's the critical detail. You have exactly 16 months to legally lock in today's exemption through 3 specific strategies, the wealthy use right now. Strategy 1, Spousal Lifetime Access Trusts SLAT. Fund an irrevocable trust with up to $13.61 from one spouse in 2024 or 2025. The trust assets grow tax-free for decades. A $5 investment account becomes $12 in 20 years, and zero of that growth is taxed. Your surviving spouse can access the trust if needed. So you're not giving up control. When the exemption drops in 2026, you've already sheltered $13.61 using the higher rate. The filing deadline is December 31, 2025. The cost to set up a SLAT through an estate attorney ranges from $2,500 to $8,000 for couples shielding $13.61. The tax savings, the difference between $0 tax today and $2.7 in tax in 2026 on that $13.61 sheltered amount is $2.7. You recoup the legal cost in seconds. One major rehook: if you wait until 2026, that same SLAT strategy saves you only $1.4 because you're using the lower exemption. That's a $1.3 swing in just 2 months. Strategy 2, Annual Exclusion Gifts. The IRS allows you to gift $18,000 per person per year, with zero impact on your lifetime exemption, 2024 limit, adjusted annually for inflation. A married couple with 3 children can gift $108,000 every year, $18K times 2 spouses times 3 kids, completely tax-free. Over the next 16 months, you're looking at roughly $144,000 moved out of your taxable estate before the exemption collapses. You can gift this to a 529 education savings plan, a brokerage account, or directly to heirs. No attorney fees. File IRS Form 709 to document the gifts. The delta, $144,000 removed today equals $57,600 in tax avoided in 2026 at the 40% federal rate, plus state taxes. If you live in New York and add state-to-state tax, 16%, that $144,000 keeps another $23,040 in your family's pocket. Here's where most people fail. They delay annual gifts thinking they have time. By January 2026, those same gifts burn through your new, lower exemption. That's $144,000 of wasted exemption space. Strategy 3, Charitable Remainder Trusts, CRT. Donate appreciated assets, stocks, real estate, business interests to a trust that pays you a fixed income for life. The remainder goes to a qualified charity. You receive an immediate income tax deduction for the present value of the charitable gift. You avoid capital gains tax on the donated assets. You reduce your taxable estate. A $1 stock donation with a 20-year life expectancy generates a $400K income tax deduction. Rough math. Depends on your age and IRS discount rate. That $400K deduction at a 37% tax bracket saves you $148,000 in income tax and removes $1 from your estate, saving another $400,000 in estate tax in 2026. Total benefit, $548,000 on a $1 donation. If you donate $5 in appreciated real estate, you're looking at $2.7 plus in combined tax savings. But there's a fourth benefit most advisors skip. When you donate to a CRT before 2026, the IRS valuation tables you use are locked in at 2024-2025 rates. These rates historically shift unfavorably in late 2026. Donate before the deadline, and your deduction is larger. The open loop. What happens if you don't plan? The exemption sunsets. Congress debates renewal by late 2025. Most expect no extension. The exemption was always scheduled to expire. Your heirs inherit assets, owe the IRS 40% on amounts over the $7 threshold, and watch $240K to $500K plus walk out the door per $1 of unplanned assets. State-to-state taxes hit next. For Connecticut residents, the state exemption is only $12.92 in 2024, already lower than federal, and could tighten further. The filing deadlines are hard stops. Any SLAT funded on January 1, 2026 uses the new $7M exemption, not the $13.61M. Annual gifts made in January 2026 count against the new exemption. Charitable trusts funded in 2026 use 2026 IRS discount rates, which historically shift unfavorably. The tax code rewards those who study it and act before the deadline.